Our first speaker for this morning is Walter Aylett, founder and portfolio manager at Aylett & Co. He and his team manage the Nedgroup Investments Bravata Worldwide Flexible Fund. The fund is a fully flexible, globally diversified portfolio with an emphasis on capital preservation. The fund aims to outperform inflation plus 5% over the long term. Thanks very much for joining us, Walter. Over to you.
Thank you, Anil, for that introduction. I think what's different about this presentation today, as we go through the normal things that we talk about, the markets, the performance of the fund, and what follows, it's 19 years to the quarter that we've been managing this fund. And it's probably one of the few funds within the Nedgroup stable that has had the same fund manager from inception, with a record that we're quite proud of. So I think to put this in perspective over the last 19 years, and certainly much longer, markets face many crises, times of uncertainty, fear, and yes, greed. And just to remind us, I mean, you can see there have been many times of great uncertainty from our history as a country in the 60s, to stock market crashes, to the tequila crisis that in 99, I think in Mexico, that followed the dot-com crisis, and then 9/11, and of course the GFC. There's no shortage of uncertainty and difficult times, and of course greedy times, as we saw the NASDAQ in 2000, and we're seeing something similar now. So when we look against this background of these factors, Bravata handsomely over this 19-year period has beaten CPI plus 5. That's quite an important number if you're saving, for example, retirement. If you follow the prudent man concept, which was a concept developed in the 60s, that if you could compound real returns of 5 to 6% over, say, 30 years, you had ample enough money to retire with. To put it into numbers, again, you can see the fund over most periods, in fact, 90% of the periods has met its target, and that's after costs, and that's quite an important point. For this year, in the last 12 months, where's the performance come from? It's come from, interesting enough, from South African companies, not so much on the offshore side. Spirit really was a bounce back from a depressed position. Reinet, listed in South Africa, but a European company, mainly made of BAT and Pension Fund Corporation. Transaction Capital was also a bit of a bounce back, but out of there We Buy Cars come, and it's been a very good investment. And Southern Sun, we bought really cheap during COVID and continues to do well for us. On the negative side, Delphi's raised has come back to the position where we bought it, mainly on the back of cocoa prices. Dollar General is a new business that we've invested in. It's still too early to talk about. Amelco is a switch into the subsidiary, so it's not really a negative contributor in a sense, but also is disappointing. The rest is too small to talk about. So the fund itself today is quite focused, is moved away from offshore towards the local region, particularly after COVID. And the global equity, one must always add back the Reinet position, which gets reflected in SA equity. And that's sitting at about just under about 55% in global equity, and South African equity about 20%. And this is rising all the time. On the fixed income side, we've been positive for about almost 2-3 years now on local fixed income. And all that's really changed is where we've moved duration every time we've had an opportunity to much longer end duration. As much of our thinking gets confirmed by lower inflation and global rates coming down, we've continued to add to that bond position. And of course, global cash is not something that we like to own because the interest rates are low, but we've been well rewarded with 5% plus in the UK as well as the US, lesser to in the European markets. But again, that's not an intentional strategy, but more as a result of either dividends and sales that we've made. So the fund today has changed quite a lot in the sense that you can see the new positions there in Netcare and We Buy Cars. These are South African companies. And the rest has almost stayed the same. With our global equity fund, we've increased a little bit more. So 40% of the fund is concentrated in these 10 investments. So what have we done? What are the transactions for the last 12 months? I mentioned We Buy Cars. This was an exceptional opportunity for us to invest in the sense that the listing was forced upon the company. The parent company needed to list, it needed cash. And it wasn't most companies list because they need capital or they need to sell. The owners, the founders want to sell. This was not the case, really. So it gave us a wonderful opportunity against a very pessimistic background leading into the elections. And we were able to get the shares very cheap. Netcare has recovered quite nicely. We bought into weakness. Remgrow is a new investment for us. And it's this theme of South African investments. Industrial companies, Super Group is another one. Dollar General is a US retailer. And the Melco Galaxy is just switching some of the holding company into 2 casinos in Hong Kong. On the exits, very pleased to say that all those sales got us handsome surpluses or profits. And we were very happy to take those profits as the oil price was quite high at the time. In terms of weightings, I've mentioned the transactions and kind of reflects in the weightings of the portfolio. Nothing's really changed except maybe Heineken. And then, of course, on the lighting side, I mentioned how we reduced our oil exposure. Berkshire had done really well for us, and we decided to spread some of those profits to other US listed companies. And Melco, again, was a switch into the subsidiary. So, as you know, we don't trade a lot. I think it's about 10% of the fund trades every year. But looking forward, I think we're in for quite an interesting time. In the long term, I don't think inflation is under control. I continuously read about salary increases around the world in 10, 20, 30%. The Boeing agreement is 35% with its workers. So in the short term, we'll see some relief from interest rates, but longer term, I've no doubt that, it feels like to me that interest rates are not going down to zero, less than 2%, and that longer term they'll be higher, which is not good for markets. Secondly, I think the US markets, particularly the heavyweight part of the S&P 500, is very overvalued, and we prefer to buy non-US large cap. In other words, the 67 or 8 that make up that tech-heavy side of the S&P 500. Prefer to buy more consumer defensive type stocks like liquor, beer, tobacco, consumer stocks that have been hit quite hard. On the fixed interest rate side, certainly in South Africa, we have real returns. If you think you can earn 10%, and in South Africa, and you've got 5-6% in the States, the carry trade gives you quite protection, a lot of protection as a South African. And the yield of the fund is very high. And what we mean by that is the equities that we own, like BAT, Ruby, just to name two, are in dividend yields about 7 to 10%. And that goes almost across the whole fund, particularly on the offshore side. And of course, as a business, we continue to hire people that allow us to invest all over the world. And nirvana for us is to find 10 investments totally uncorrelated to each other in 10 different parts of the world. And to some extent, we have achieved that, but we're always looking. And while the fund has been a bit subdued the last year to date, it's a very, very good time to buy Bravata, in my opinion. Our best investments are made in a time when things don't look so great. And because of our conservative approach and not going with the herd, not for the sake of not going for the herd, but I can't help feeling that we've been here before, and that the next 5 to 10 years are going to be very difficult in the markets. There's no shortage of uncertainty, and my best view is that we're going back to the 70s, where we had wars, we had tariff increases, protectionism policies, very bad politics, which is an obvious thing to say. But I think the dividend that we got from the Iron Curtain coming down 25 years ago, that's over now, and that's a difficult place for stock markets and asset prices. So with that, we caution investors to expect much lower returns. It's been a good 19 years, and I look forward to the next 19 years. It's over to you, Anil.